Hi, everybody. My name is Ian Farmer. I'm the Vice President of Corporate Development at Osisko Gold Royalties. I'm a mining engineer by background, but spent over a decade in mine finance. So our partners, and especially Guy, have done a really excellent job outlining our high-quality asset portfolio. These basically represent the fruits of past corporate development activities. So what Mike and I are going to run you through today is really how we think about making new investments and executing on new opportunities. So first off, what I'd like to do is just outline our approach to corporate development. It's a simple strategy. Royalties are a really great business. We've got disproportionate upside to the assets that we invest in. And there's also a level of downside protection as well. And this leads to excellent, consistent free cash flows that generate a higher multiple in the marketplace. Specifically in royalties, Osisko has an exceptionally high portfolio of assets. So our job as a corporate development team is really to complement the existing portfolio while adding accretive growth. So we do this with an increasingly heightened focus and emphasis on pure play royalty and stream investments, with a preference for near-term cash flows. At Osisko, we see ourselves building the premier growth-oriented royalty company. As Guy mentioned, as our partners mentioned, we have excellent internal growth. We are trying to execute on intelligent new growth. And really, we're lucky. We're privileged in the mid-tier space because as a corporate development team, individual transactions for us can still move the needle. So we really feel that this diligent approach to capital allocation, combined with our current excellent portfolio, is really a strong investment case for our shareholders. But to emphasize the fact that we're committed to be diligent and to this strategy of disciplined growth, I'm going to highlight the track record. So this slide highlights our recent track record of transactions. As you can see, it's been heavily focused on pure play streaming and royalty investments, smart accretive transactions that complement the portfolio. We've been very active. Guy has touched on some of these investments already, and we'll touch on some others further on in the presentation, some of the newer ones that we've made. What you can also see is that we've rationalized some of the higher risk portions of our business. We spun out the mining assets, specifically Caribou and San Antonio, into Osisko Development. And we've also been able to deconsolidate Osisko Development from our financial statements. Importantly as well, over this period alone, we've had a disciplined approach to returning capital to our shareholders. Through a sustainable and progressive dividend, we've returned over $140 million in dividends alone, just over this period, as well as being opportunistic with share buybacks on our NCIB, where we've returned almost $80 million at an average price of just under $13.50 a share. Along the way, we've also delevered the balance sheet to set ourselves up for continued growth. So we believe this track record speaks for itself, and we're definitely looking to continue along this path. So what is a royalty business? We're a financial services business. We allocate capital to the mining industry, and that capital allocation decision, that's really the core part of our business. So at Osisko, we have 4 key pillars that dictate what our capital allocation strategy is. The first pillar is quality. Quality in jurisdiction is paramount. As a past mine developer and operator, we understand how difficult it is to permit, build, operate a mine, even in the best jurisdictions. So as a royalty holder, understanding that the asset you're investing in is going to retain an operating license over the long term is critical. Of course, we look at asset quality as well. The natural endowment of the deposit, grade, size, ore body depth, ore body orientation, exploration upside, all these things. But these things are dictated by nature. Nobody can control them. So we have to be extra diligent when reviewing these aspects. The characteristics of the asset that you can control are things like engineering, resource modeling, sampling, and these can be controlled by management. So as such, we also look for quality management teams that have an excellent track record of delivering projects, operating well, but also the ability to attract and raise other sources of capital. So our next pillar is context. Knowing where we are in market cycles is very important, being opportunistic in royalty investing and reaping those benefits when markets improve. Royalties benefit disproportionately from the cyclicality of mining. So playing off these cycles can really generate excess returns for us. So also understanding where an asset sits relative to other assets, not only on the global cost curve, for example, but on the regional cost curve as well, in the development pipeline of the operator. These are the factors that'll allow you to assess the viability of a project over the long term. And then lastly, in terms of context, as a capital provider, it's the norm, especially nowadays in mining, to have more capital, to have more opportunities than capital to deploy. So comparing and contrasting our opportunity set on a relative basis in context is key to our success. The next pillar is portfolio. At Osisko, we really take a portfolio approach to investing, where we're building a grouping of assets that have the best risk-return characteristics for our investors over the long term. So we're fortunate to have an existing portfolio that's already extremely high quality. And as a corporate development team, we need to be mindful not to simply do transactions for scale that would eventually dilute the quality of our current asset base. Given the balance of our portfolio now, we are more focused in the near term in terms of adding near-term cash flow. We feel it's the right fit for us where we are now. And as we all know, in today's royalty landscape, near-term opportunities of scale are hyper competitive. So it's an expensive place of the market to play in. We've picked our spots recently. We think we've picked them wisely. We'll continue to do that going forward. But given that that's a focus for us in terms of adding near-term cash flow, we'll have to be mindful of that. What we're mindful of as well is also sprinkling in the right, highly selective development stage assets to balance out the returns of the portfolio. The last pillar is responsibility. Responsibility is a core value at Osisko. It means being accountable, holding others accountable, being diligent in assessing opportunities and risks, and also paying attention to our footprint and impact that we have on others as an organization. So these are the key principles that guide Osisko's capital allocation decisions. Now we'll move to the process itself, how we actually execute on transactions. So the first step, this process is probably the same for any group. I'll try to outline how we think about things, how we do things a little bit differently. The first step for us is origination, proactively targeting those high quality opportunities and those high quality management teams that have higher probability of success. Then we're building relationships with these people, understanding what it actually is they want to achieve. This collaborative approach of having a similar goal, understanding what the use of proceeds are, it's critical in terms of developing these bilateral relationships. Even if there's not an immediate opportunity, these conversations are always fruitful and are a major part of our business. Once an opportunity does become available, we move on to due diligence, where in a given year, we could easily review over 100 opportunities, and only about 5% of these opportunities actually pass our strict DD criteria. And as you can imagine, we review everything, soup to nuts, technical, legal, environmental, tax. I mean, we do it all. But on the technical side, we pay specifically close attention to those aspects of asset quality that are outside anyone's control. So for example, on the resource, where it's merited, we will take the drill hole composites, we'll build our own block model, we'll run that block model through the operator's mine plan, and we'll assess the risk in that profile. And the reason we do this, and the reason I'm using this as an example, is because in mining, oftentimes the irreparable failures are oftentimes driven by a misunderstanding of the resource. So once we're comfortable that an asset is moving well through DD, the next step is to get serious about the commercial discussions. And this is really finding a win-win solution that best meets the partner's objectives, but while also meeting our needs as a royalty provider. And we can do this through negotiations and balancing the risk-return trade-off of the investment. Concurrent and related to this is structuring, both legal and tax structuring of the investment. And one asset that I think is maybe not as appreciated from the outside looking in is the vast discrepancy in quality of royalty and streaming contracts in the marketplace. So as a royalty holder, these essentially are our assets. And we take great care in structuring our investments. And at Osisko, we're extremely proud of not only the quality of our mining assets, but of the quality of our investment assets as well. Because at the end of the day, shielding the returns, protecting against loss, that's what really gets you to the fantastic exposure to the long-term upside inherent to royalty investments. And then lastly, once a deal closes, it's not over. We're building a partnership. As a service provider, we rely on reputation and repeat business. Word of mouth goes a long way. You work with people you like, with people you trust, and wherever possible, we strive to provide more than just a check. And I think Marty at Victoria made a good allusion to this, where we seconded some technical people to assist with the build. So with that, I'll wrap up. I'll pass it over to Mike, who will talk to you about some of our more recent check writing activities and some of the new deals that we've done.
And see if there's any questions before we turn it over to the MAC team. Go ahead.
Yeah, I wanted to ask about, have you thought about adding some leverage to your royalty portfolio, like doing some sliding scale royalties?
We have one sliding scale royalty, I would say, for sure, in Eleanor. It's not necessarily in terms of price, it's in terms of ounces. You're saying price? It's not something we've actively pitched, truthfully. Typically, we would try to capture as much upside as possible. So I don't know which way the scale is going in your mind. If it's going,
well, you would have a base, obviously, choose your gold price, 15 and 1600 the space, and then you provide some upside leverage for your subs. And I just wondered, because I look at all of them, they're all fixed royalties.
Yeah.
Have you thought about that? Is that something new?
I think the way that we would like to do it is increase the royalty as the gold price goes up, but I'm sure that our partners would not like that. The other way around, if we decrease it, I'm sure the partners would love that, but not something that we'd love. So not something we've actively pitched, truthfully.
And then my second question would be just I hear this from every one of the companies I follow, that everyone's stream contracts are better than somebody else's. So maybe from your perspective, can you tell us why you believe your stream contracts, what makes them superior to your peers? So what do you embed in your contracts, unless they're all on CDAR and we can download them and go through them? Can you tell us like sort of the top 3 aspects of your contracts that makes them superior? So
certainly, all of our key royalties and most of the 180 cover all the property. That's number one.
I'm talking about the streams, though. I thought like the royalties.
So the key thing that it goes unnoticed or unacknowledged in a lot of times is security package. No doubt about it. We've seen some of our peers spend significant amounts of money on streams that are unsecured, that are in special purpose vehicles that have no other assets, where if you don't actually get paid, there's not much recourse. You're kind of betting on somebody's reputation. And that's not something I think Osisko is necessarily wants to do. We see these assets transact hands all the time. The person you know today that you're doing the deal with is the person, it could be your friend, but in 10 years, that's not something, you might not be in the ssame place. I would say for us, one of the key focuses, and royalties in certain jurisdictions are better than streams, but survivability is key. That if our royalties are not our streams aren't survivable through cycles, then there's not much, like the upside that is inherent in owning a stream or royalty doesn't matter. So someone could pitch, I have an 80-year stream, but if it, as we know, this is a cyclical environment. If copper price drops or if gold price drops, and those those assets start to have trouble, the first thing that could go with those streams.
Yeah, I mean, obviously they're contracts versus royalties to stick to the property.
Yeah.
So in your royalties, I'm assuming it's like everybody else, it sticks to the property and it covers, whatever the property, how you define it.
Yeah, and
there are other things that I should be aware of.
And you can certainly take security with royalties as well. And the one thing, and Mike's right, it's all about survivability. And security is a great way to protect against that. And then depending on which jurisdiction you're in, sometimes even an unsecured royalty can put you in a very favorable position versus somebody with a security package. The other piece of that is the intercreditor discussions, because you can have security, whether that's senior or subordinated. Typically, as a royalty holder, you'll end up being subordinated unless you are the biggest piece of the financing. But being treated as an operating expense. So in a default scenario or an enforcement, if you're treated as an operating cost, then you can get paid through what could be a very long, drawn out process of enforcement. And Mike and I have both been through learning curves on CCAAs and learning experience that we can use to build more strength into our contracts.
Thank you.
Does that answer your question?
Somewhat.
Yeah. Ralph?
It was earlier on, I think it was Heather who said $750 million of deals that passes on in the last 2 years, right? She said ESG related matters. Just wondering, was this, is there any similarity of those where this was sort of a yes or no on the jurisdiction, or did you attach a risk to that and it still didn't meet the investment threshold?
When we look at, kind of goes back to the portfolio approach. And when we look at it, we tend to look at from a specific opportunity. We tend to look at it from 3 things: people, place, and project. And what we've said is we could go into jurisdictions, if we're talking about jurisdictions, with the right people for the right project and with the right project, but we wouldn't go into a riskier jurisdiction for something that is the wrong project or a tier 2 with the wrong operator. We've had a very long learning curve on some assets, and people really can make the difference in those tricky jurisdictions. I would say that is almost number one. Some people know how to operate in jurisdictions and some people do not. And so that would be a key focus of ours. There are certainly jurisdictions where even recently we have just said there's absolutely no way we're going to go into that. And this is just an interesting fact, is that we're considered one of the largest exporters in Canada for some odd reason because we export our gold technically. And so we have great access to the EDC. And through them, what we've been able to do is before we go into any jurisdiction, we've actually had access to the Canadian government in each of these jurisdictions. And we've actually picked their brain and said, is this something that we can do? Tell us what we need to know. And based on those conversations, we've completely nixed certain jurisdictions for sure.
Just to add to that, I'm the person who said those numbers to Heather. None of that number is places that we would never do business. All of that uninvested capital is places that we would go, and after looking at over other risk factors, which is a lot of investable. And in some cases, it's a combination of factors, but where ESG is the core of the decision to no-go.
I mean, there's also been large investments that we've passed on pretty quickly just because of things like not believing in the ability to increase tailings capacity as well.
Or not liking their current tailings facility. We passed on one just for that specific reason. So Grant has given us the hook here. Any one last question if someone's got something quick? Nope.
Thanks, everyone.
All right, thank you.